Economic crossroads, UK faces fiscal tightrope amidst growth prospects. In a comprehensive health assessment of the UK economy, the International Monetary Fund, IMF, has released a stark warning. Difficult choices lie ahead as the nation grapples with a looming fiscal deficit. The report's findings cast a shadow over Chancellor Jeremy Hunt's pre-election plan to reduce national insurance contributions, NICs, prompting Downing Street to express its disagreement with the IMF's cautious stance. Downing Street's spokesperson firmly rejected the IMF's argument that a third NIC reduction in less than a year is unwise, emphasizing that cutting national insurance and rewarding work are critical elements of economic growth. This stance reflects the government's belief in the stimulative effects of tax cuts on labor supply and economic activity. However, the IMF's concerns stem from the potential impact on public finances, which have been severely strained by the pandemic and the ongoing conflict in Ukraine. Kristalina Georgieva, the IMF's managing director, stressed the need for fiscal prudence and warned that rebuilding fiscal buffers is crucial for all countries that have heavily depleted their reserves. The IMF's analysis highlights the potential consequences of further NIC reductions, suggesting that the Treasury may need to consider a range of unpopular revenue-raising measures to address the looming fiscal gap. These measures could include expanding the scope of value-added tax, VAT, implementing road pricing, discontinuing the triple lock on state pensions, increasing inheritance and capital gains taxes, and imposing wider user charges for public services. Despite these fiscal concerns, the IMF acknowledges the economy's resilience and anticipates a soft landing, following a faster-than-expected decline in inflation and the recent end of a shallow recession. The IMF projects UK growth of 0.7% in 2023, exceeding the 0.5% forecast in its previous World Economic Outlook. Moreover, the IMF notes that the Bank of England may consider reducing interest rates from the current 5.25% in the coming months, suggesting a potential easing of monetary policy. However, the IMF cautions that long-term growth prospects for the UK remain subdued, posing challenges for public finances amidst increasing demands for public services and critical investment needs. During its 2-week article for consultation in the UK, the IMF team conducted a thorough assessment of the nation's economic health. While acknowledging the government's stated plans for modest increases in departmental spending and flat investment spending, the IMF emphasizes the need to address known pressures in public services, particularly in healthcare and social care, as well as critical growth-enhancing investments, including those necessary for the green transition. The IMF team's projections estimate that debt as a percentage of GDP will continue to rise, reaching 97% by the end of the decade, assuming a 2% real growth rate in departmental spending. To stabilize debt by 2029 to 30, the IMF estimates that the government would need to raise revenue or implement savings equivalent to 1 percentage point of GDP, approximately £30 billion, entailing tough choices for policymakers. Chancellor Jeremy Hunt, in responding to the IMF's assessment, expressed optimism, highlighting the report's acknowledgement of the UK economy's positive trajectory and projected growth exceeding that of other major European economies over the next 6 years. Hunt urged a rejection of unjustified pessimism and emphasized the government's commitment to sound fiscal management. The IMF's health check serves as a timely reminder of the delicate balancing act facing the UK economy. While growth prospects appear promising, fiscal challenges cannot be ignored. The government's ability to navigate these challenges and make informed decisions on taxation and spending will be crucial for ensuring long-term economic stability and prosperity.